Okay, thank you for for allowing us to present the paper at the conference. The paper is with Zaib and David, a colleague of mine, Mark Johnson, who is at Brigham Young and is here today, and his role is to answer the questions I can't answer. We are looking not at consumer loans, but we are looking at small business loans through FinTech. But I want to say that this is like an Ohio session because Upstart has most of its personnel in Columbus, Ohio. Now, a strength of FinTech, both for customers and individuals and small business, is to improve access to credit. And before COVID, small businesses that could not access bank credit could often obtain funding through FinTech. And so what we look at in this paper is whether FinTech performed this role for small business during the COVID crisis. Okay, and what we'll find is that in some sense it did not, and we'll try to explain why. Now, what motivates us is when you look at lending through FinTech, small business FinTech mostly, there is kind of a collapse taking place with COVID. On the other hand, when you look at the banks, you don't see anything like this. So the evolution of the banks is bank lending is quite different from the FinTech lending. The green here is the small business loans by banks. They actually increase in the first quarter of 2020, whereas the FinTech small business loans decreased during that quarter. Okay, so we have a very different evolution. So what we do in the paper, we have data from a FinTech lending marketplace. That's a platform where people apply for loans that are directed to online lenders. And so one thing that is neat about the paper is great kind of generally is that we observe all the applications. So we observe the demand, we observe all the offers, so we observe the supply, and we observe the outcomes, the deals that are made. And so it's a setting that is quite unusual where you can identify the demand and you can identify the supply separately. And I think that's one of the exciting things about what we are doing here. There's a large decrease in loan volume. So the obvious question is it due to supply or is it due to demand? And we will hope to convince you that it's due to supply. And then once we have done that, we address the question of why did supply decline so dramatically? So our findings are that the number of funded loans declines dramatically, but that's even though the demand increases during March. Okay, but the supply drops sharply. We compute the probability of receiving an offer. At the beginning of the month, it's 54.2%. At the last week of the month, it's 13.2%. So that's a pretty dramatic drop. We hope to convince you that the explanation involves financial constraints on the lenders and involves issues having to do with model risk. So kind of the bottom line is that the funding of small business FinTech lending really prevented them from being a lifeline for small businesses when COVID hit. So the outline will look at FinTech versus bank lending. We'll look at the demand, the supply. We'll look at some evidence from the public FinTech lenders. Unfortunately, for small business, there are only two of them. Small business online lenders, there are lots of them. They are mostly private companies. The capital, the funding for the loans comes from VC, PE, bank debt, securitizations, bonds. Those lenders don't have deposits, so they don't have any deposit funding in contrast to banks. They make unsecured loans. Typically, they are short-term. Typically, they are relatively expensive. There are also loans that are quite different from the loans to individuals, to consumers. The loans to small businesses involve repayments that sometimes are daily or weekly, whereas the consumer ones tend to be monthly. So when you look at the banks, now the funding model for banks involves deposits. And I am sure you have seen kind of the incredible increase in deposits during March 2020. At the same time, there was a very big increase in loans by banks during that month, but they had the deposits to fund them. So the platform that we look at, it receives applications, it distributes them to lenders. Now, lenders have preferences for the type of loans, and so the applications are sent to the lenders that have preferences that are compatible with the application. Before COVID, there were more than 30 active lenders on the platform. And once you apply, an offer is made within hours, and the loans are funded within 1 or 2 to 3 days. For March 2020, we have 6,550 completed applications. The average loan amount is 59,000, and the average APR is 80%. So here we have a plot of the loan volume, the number of funded loans. I could show a plot for the amount funded, and it would be similar. And so what you see there in red is March 2020. The blue is March 2019. Okay, and you can see that at some point in, I'm sorry, so we have from January to the end of March. And so March is here, and you can see that the amount, the number of loans funded drops dramatically. It starts dropping at the end of the first week of March and goes to very little by the last week of March. So let's look at the demand. Now we observe the number of the applications, the number of applications and the amounts requested, and both increase sharply. Now on the left, we have the number of applications. On the right, we have the financing sought in millions. And you can see that it increases very sharply, and kind of is at a peak on March 15. And then you can see that over time, what happens in Washington has an impact on the applications. When the stimulus was blocked in the Senate, where there was a spike in applications, and then towards the end of the month, obviously the demand falls because people are starting to expect PPP. On the right, the red is for March 2020, the blue is for March 2019, and you can see the same pattern, which is a very large increase. Then over time, there is a decrease. Okay, and so we look next at whether it's related to measures of the severity of COVID in the state. We look at states with lockouts and states without lockouts. There is a bit of difference. The blue is the more restrictive states, but there's not that much of a difference. On the right, we look at individual industries, and we normalize that by what happened to the industries in March 2019, and we call that the abnormal level of applications. And you can see that the pattern is similar across industries. So in terms of the risk characteristics of the borrowers, whether that changes in March 2020, given the time, I'll focus on the FICO score. Now it's 650 in March 2019. It's 671 in March 2020. Now, so there are low FICO scores, but they are not, that kind of borderline subprime in 2019. A little bit better in 2020. The Number of employees is 7 in 2019 and goes to 8 in 2020. So now the creditworthiness of the applicants is at least as good in March 2020 as it was in March 2019. So a decline in creditworthiness based on kind of historical characteristics can't explain what happened. Now you might say, well, I mean, maybe what's going on is just the platform becomes more attractive over time to better credits. But so if we look within March 2020, we also see this, we see an improvement within March. The FICO score is better in the second half than in the first half. So what we find for demand is that it increases. The increase is not associated with a decrease in the creditworthiness. Obviously, it's creditworthiness looking backwards. Now, I mean, what the FICO score reflects what you have done in the past, and not looking forward with the impact of COVID. But so we have an increase in demand, and the applicants appear to be higher quality. So demand doesn't seem to be able to explain what happened. Let's turn to supply. So for each applicant, we have the offers that the applicant receives. So we have the number of offers. And so controlling for applicant characteristics, we can ask whether the date of application during March impacts the offer likelihood. Now, how likely are you to get an offer? And so now, as I said at the beginning, we find a very sharp decrease in the likelihood of an offer. So I'm going to show you the regressions, and then we'll turn to whether this reduction is related to the economic condition, local economic shock. Okay, and so we estimate regressions where we have indicator variables for each week. We have industry fixed effects, and we control for the applicant characteristics. And what you can see now, the key of the table is this decrease in the probability of acceptance of receiving an offer. Now, the dependent variable is whether you receive an offer or not. And we can see that this decreases dramatically during the months. So the last column on the right, now the sample is the first 3 months of 2020 and the first 3 months of 2019. And those are the same indicator variables for the weeks of March of 2019. And obviously there is nothing there. Then we look at kind of the local severity of the pandemic or what the state was doing. We have an indicator for lockdown. And we use data from SafeGraph, which tells us the percent of population at home during a day or during a 7-day average. And we can see that lockdowns decrease the probability of an offer a little bit. And the percentage staying at home doesn't seem to have any impact. And in those regressions, we control for characteristics. We have an application date fixed effect, and we have an industry fixed effect. So concerning the COVID impact on supply, now the regional shocks account for some of the reduction in supply, but the effect is small. When we add the regional shocks to the regression with weekly indicators, the coefficients on the indicators really don't change. So it seems that the decrease in supply is really across the board rather than located in regions with high COVID impact. So the next part of the supply that we looked at, now we looked at the probability of getting an offer. We also want to look at the terms of the offer. Now, if the problem is that there is more risk and that leads to the dry up in the supply, then you would expect lenders to become more conservative, and so smaller loan sizes, shorter maturity, and higher APR. Okay, and so we assess how the offers change across time and across COVID severity, controlling for the characteristic of the applicant. And one result that's quite surprising is that the terms really don't change. Now the APR doesn't really change. The maturity doesn't really change, and the loan amount doesn't really change. Now, those regressions are estimated using controls, not the characteristics of the borrower, using industry fixed effects, and using lender fixed effects. So we look at variation within lenders. And now we estimate this both for March 2020 and then January to March 2020. So those types of results are hard to reconcile with lenders being worried about the risk when they cut the supply. And here we have the offer terms as looking at the impact of COVID exposure. There's absolutely nothing. No, so the decrease in supply seems to be mostly unrelated to what happened with COVID in the area where the applicant lives, or in the industry where the applicant has his or her business. So the bottom line, the supply falls sharply as applicants become substantially less likely to receive an offer. Supply worsens throughout March. COVID exposure has some effect, but most of the drop cannot be explained by that exposure. So why did supply fall? Well, the lenders have two problems in March. Now, one is the net worth falls as loans become delinquent or expected to become more likely to become delinquent. With those small business lenders, the impact of delinquency is very rapid. Now, in the sense that because the lenders have to pay interest frequently and have to pay back frequently, you notice a shock very quickly. So there's a net worth effect, and then now they are funding their loans not out of deposits but out of money raised, and the funding for loans becomes difficult. Okay, and so the degradation in the loan performance impacts the funding. Many of the facilities for the funding of the loans depend on the performance of the loans. And so if the performance falls, it has a direct impact on the facilities, and has a direct, for those that use securitization, it has a direct impact on the securitization. Okay, and so with the lending facilities, the lenders need a sufficient equity cushion to satisfy covenants. And then if they make a poor performance, that forces them to contract lending. So what do we see? Now, if liquidity dries up or capital becomes deficient, we really expect the lending to come to a sudden stop. Now, if the lender doesn't have the funds to fund loans, then that's going to be a stop. If lending risk increases, but lenders are well capitalized, you would expect lenders to decrease the risk of their book, measured by FICO, and charge more. Okay, we have already seen that they don't do that. They don't charge more. They don't decrease the riskiness of the loan. That's not what happened. They suddenly stopped. Okay, so if it's not this effect, if it's the effect that the lenders become constrained, what you would expect is the lenders who lend to the riskiest borrowers to be the ones that would be affected first, and to be the ones that would stop lending first. Okay, there was this discussion in the first session about lenders having a preferred habitat in terms of riskiness of the borrowers. And in this market, that preferred habitat is quite clear. Mark Johnson, in his dissertation, shows that very nicely. So we expect the lenders to the riskier borrowers to be affected first, and we expect the lenders to the riskier borrowers to drop out first. Okay, here is an example of a lender dropping out. Okay, so that's a fraction of loans accepted, and suddenly that fraction of loans goes to zero. Obviously, the demand follows because that lender is no longer sent loans. And so that's kind of what you see happening with all the lenders who drop out. Now suddenly they stop accepting, stop sending offers. And here we have the number of active lenders. The blue is 2019, the red is 2020, and you can see that the number of active lenders just collapses and leaves the market. We look at the relationship between lenders dropping out and their prior risk-taking. The way that we measure the risk-taking of lenders is to look at the median FICO score of the borrowers for that lender. Okay, and so what we find is that the lenders who have a lower median FICO score, so they were willing to lend to borrowers who are riskier, that those drop out first. Okay, and the ones that have a higher median FICO score drop out later. Okay, that we have kind of three outliers here that are problematic. All the other ones kind of behave as we would expect. So let's look at the supply cuts on the risk of the lenders. Now, what we can do is we can look at within applicants which lenders make offers. Okay, and so what you would expect is that a riskier lender would be more likely to make an offer, everything else equal. Okay, and that's what we observed before COVID, which is the riskier lenders were more likely to make offers to applicants than the less risky lenders. Now, the less risky lenders were tougher, as you would expect. But then we get to the COVID period, and there is no difference. Okay, meaning that the lenders who lend to riskier borrowers are no longer more likely to make offers. Now, and that's consistent with them having become constrained. So we do that in a regression where we have applicant fixed effects. So we are looking within applicants. And you can see that in January and February 2020, the higher the median FICO of a lender, the less likely the lender was to make an offer. But then when you look at the, you interact that with indicator variable for the period of March, you can see that that effect is completely offset. The probability of an offer doesn't depend on the median FICO of the lender. Okay, we just a couple more slides. I will 55 seconds. I'm good. So some lenders are public, and we can get some evidence from them. That's Cabbage, which is a lender that is public, and they had a securitization. And you can see what happened to the B note piece of the securitization. The prices went from 100 to 10 to about 10. Now that's pretty dramatic. They went back up afterwards. On deck at publicly traded equity. And now at the end of the first quarter of 2019, that's 7.6% loans that were non-paying. At the end of the first quarter of 2020, that 22% of loans that were non-paying. So a pretty dramatic increase. This is what happened to the stock price. No, one thing is that both of the public ones are no longer public. No, I mean, they no longer exist as standalones. Looking at banks, now the approval rate of banks for small business loans stayed relatively constant during that period of Q1 2020. And so it's a very different story. So conclusion, the strength of fintech lending is to provide funding for borrowers that cannot access bank credit. Yeah.
Yeah. So we could have the discussion.
Oh, okay, sorry.
Okay. So we have the discussion Professor Tetyana Balyuk from Emory University who will discuss.
Right, I hope that you didn't give ideas to the discussant about how to treat me.
Okay, so thank you so much for inviting me to discuss this paper. I have done research on fintech lending for probably 6 or 7 years already, but every time I do it, I find something new that is interesting and I'm excited about. Specifically, if you look at this slide and this article on the left, there has been a lot of discussions about how would fintech lenders do in a time of economic shock. So those, fintech consumer finance lenders and fintech small business lenders emerged during the last or after the last financial crisis, but they didn't really, the volumes were really small. So we don't really know how they have weathered a financial crisis. And now when COVID hits, now we can study the response of fintech lending to actually an economic downturn, which is really exciting. So let me read to you this quote that is underlined here. I know you can't see it, so I'm going to read it to you. So this is what the executive at Funding Circle said. We think we'll do pretty well in a recession. So the tension here is, well, if fintech lending really relies on some advanced machine learning models, then during a recession, they should increase their lending because they can capture some of the clients that banks would ration in a time when there is such a high uncertainty. But if the models of fintech lenders don't do as well, they would probably cut their lending even more than banks during a recession. So that is something that we were not certain about. And this paper deals with this question in the context of small business fintech lending. And one of the mechanisms that the paper has in mind, which is different from this model risk or uncertainty mechanism, is the financial constraints channel. Differently from banks, fintech lenders rely on equity and debt contributions directly from investors. They don't have a deposit franchise. So when there is this uncertainty that hits, the assumption here is that those providers of finance will withdraw new credit to fintech lenders. And that is what the paper shows. So I think that the paper tackles overall a very important question and provides evidence for a novel mechanism. And I also would like to compliment authors for bringing some proprietary data to this discussion. Small business lending, especially fintech small business lending, is an area where data is really important. There is not a lot of public data we have. So a lot of studies, including my work with Alan Berger and John Hackney, rely on these proprietary data sets. Since the paper has like many robustness checks, and I really think that the authors brought this analysis as far as they could with existing data. That's why I would like to provide some more big picture and high level comments. So I hope they will be useful. I organized my comments into 3 buckets. One is about external validity and generalizability of the findings. And the reason I have these set of comments is because the paper in its writing, at least in the version that I read, pushes for generalizability a lot. So the authors discuss those balance sheet lenders that originate loans and keep them on the balance sheet. They also talk about so-called marketplace lenders that attract investors who fund the loans. and they argue for the same channel for these two types of lenders. And the authors also talk about small business lenders and consumer lenders, and also argue that the results they have are applicable across the board. So I'd like to challenge them a little bit in this. And then secondly, I will talk about the mechanism. So the authors really push on this finding constraints mechanisms, and let us see if it can hold in other types of markets and situations. And then lastly, I think an interesting question is that, well, how do fintech lenders do compared to banks? So the arguments in the paper rely a lot on the differences between banks having a deposit franchise and lower funding costs, and between fintechs that don't have this type of franchise. So I got really excited about this paper and about what they have to show about COVID, to the extent that I did a little bit of a replication exercise. So this graph on the left is the graph from the paper, and the setting in the paper is more of a referral network rather than a typical marketplace lender. So the platform that the authors get data from basically collects applications and then refers them to multiple online lenders. And I would really like to learn a little bit more about those lenders in terms of, are those all balance sheet lenders? Are those really marketplace lenders? But those lenders on the other side of this referral network are a little bit of a black box in the data. And I understand that authors have data limitations, but that could be important for the conceptual analysis. So I did, first I started with these demand results in the paper, and I replicated them using Prosper marketplace data. So Prosper would be a consumer fintech lender, so this is a different segment, and this is a marketplace lender, so again, a different segment. But just because the authors argue a lot about generalizability in the paper, I felt that it's an appropriate exercise. And so an analog for consumer finance of this referral network would be Credit Karma, that could refer loans to Prosper marketplace. So we have these analogs here too. The other good thing about Prosper setting is that Prosper does not have skin in the game, and we can look at the investor funding decision, so it can unravel that black box that the paper cannot unravel. So the first exercise I did is just look at the demand, and you can see that the results replicate really nicely across the board. So whatever the authors are showing for fintech small business lending seems to be holding on the demand side for consumer fintech lending. So this is great. I was really excited about those results. Now, the next thing, I looked at funding. And when I looked at the graph from the paper, which is this one, I was like, holy crap, that's a really large drop in lending. So those small businesses have to be really, really constrained. And this drop in funding does not follow the previous graph on the applications. So it got to be that lenders just ration some customers here out of the market. Well, I don't see those results quite in the consumer finance space, at least for Prosper marketplace. If you look at applications in this black line, and then the gray line for funded loans, they follow one another quite closely. So my question is the difference because we have the difference between a balance sheet lender and a marketplace lender, or is it because we're talking about small businesses versus consumer loans? So I kind of wonder, why do we see those differences? And do they have to do anything specifically about fintech lenders or not? So I'd like to learn more about those differences in those markets. Another thing I wasn't really sure about in the paper is that, well, how much that decline is driven by just one lender. The others have a schedule of lenders dropping out of these referral network in the paper, but it was a little bit difficult for me to map these dates to these graphs because the authors argue that they have one definition for the lenders dropping out, and another one is when they actually reduced making offers. So I would like to challenge the authors and give us a little bit more information on this. In addition, since this is a referral network, I wonder how much of the effects are specific to that network versus these lenders cutting credit more generally. It may be the case that those lenders on this referral network, they just stop using the services of this referral network. And just, anecdotally, we've seen that happen in consumer fintech lending too, when certain marketing channels were just cut during the COVID crisis. So can we generalize those results outside of a particular platform, particular referral network that the authors have data on? Now let's talk a little bit about the mechanisms. So the authors put forward two main mechanisms for the drop in fintech small business lending in the paper. One is so-called funding constraints. Whenever default risk on existing loans of the lenders goes up, lenders don't have as much capacity to fund new loans because their investors are not giving them funds. The second mechanism is that just the general increase in uncertainty and model risks lead to credit rationing in that market. And unfortunately, the authors don't have direct evidence on the dry up of funding to those lenders. So they rely on this indirect evidence and say that, well, we'll look at the loan portfolio of those lenders pre-COVID. So if these lenders served riskier borrowers, the argument is that, well, they should continue serving riskier borrowers and maybe tap into even riskier borrowers at the time of COVID. I don't necessarily think this should be the case because when a shock like COVID hits, the defaults materialize much more than during the normal part of the credit cycle, but there is a higher divergence in defaults between safer loans and the riskier loans. So in other words, riskier loans default more, but they default much more relative to the change in defaults for safer loans. So if we believe in this traditional arguments about credit rationing, then riskier lenders should also cut more of their clients, should ration more of their clients during economic downturns. And this still goes into that uncertainty model risk argument. And this argument is not unique to the funding constraints argument that the authors are making. There's another mechanism which I would like to propose, which is the subject of Merton and Thacker's theoretical model, which basically says that, well, when defaults increase on a lender, investors stop trusting the lender. So even if defaults increase just because of bad luck of the lender, they could leave the lender because they don't trust the fintech lender anymore. And this is a little bit of a different mechanism to the other two that the authors argue. Now, going back a little bit to my replication exercise based on Prosper Marketplace, what I plot here on the right is the probability of funding by investors, so by those who provide funding to Prosper Marketplace and fund loans. And I don't see quite the same effects, at least in the consumer credit market, because funding rates drop a little bit towards the mid of April, so about 1 month later, but then they rebound. More consistent with the uncertainty or model risk channel than the funding channel in the paper. And if you read these announcements from Prosper Marketplace and Lending Club more closely, you see that the platform decided to ration some borrowers out of the market and not like investors decided to not fund the loans. Now, let us think about whether we are surprised by these results. So an economic shock hits, obviously uncertainty goes up, credit risks go up. So if we believe in the standard, Stiglitz and Weiss framework, what should a lender do? Any lender, including a bank lender. It should increase interest rates and should ration the riskiest types of clients. So what this paper shows us today on fintech small business lending is exactly the same results. So an economic shock hits, and then online lenders don't provide credit at the same rate as before, and some of them drop out of the market. So are we surprised? Well, probably not, because that's what they should do if the uncertainty becomes high. But what would be more interesting to me is to compare this, what fintechs do, to what banks do in small business lending. And if you look at the introduction of the paper, the authors argue a lot about the differences between banks and the differences between fintech lenders. And that's a first order question to me too. So because of that paper's focus, I thought maybe the paper could do a little bit more. I'm not sure the authors have data to do it, but a really good test here would be to take the set of customers that have similar loans that are similar in credit risk and look at how bank lending responds versus how fintech lending responds. And we have some, contradictory evidence in the existing papers about this. So it would be nice to learn more about these aspects. So just, to summarize, this is a really nice paper, and I think it's a timely paper and answers an important question of how fintech lenders, and specifically fintech small business lenders, weather an economic shock. Do they increase lending? Do they cut lending? But I would like to learn more about whether the results in the paper are specific to a balance sheet lenders, or should we expect really external validity to marketplace lenders? Are they specific to small business lenders, or can we generalize to other segments like consumer loans? Are the results specific to that referral network, to that platform, or do lenders, these online lenders, cut credit across the board to small businesses? If there is a way to provide more direct evidence on the mechanisms, I think it would dramatically benefit the paper. And then lastly, can we say more about the differences between banks and fintechs that provide small business loans during a recession? So thank you. I look forward to the next version.
Thank you, Professor Balyuk. Now, Professor